Empire Earnings. Build your financial empire.
Spring is typically the season when borrowers apply for new mortgages or hunt for premium rewards credit cards. There is a direct mathematical relationship between your credit score and the interest rates banks will offer you. A higher score proves to lenders that you are a lower risk, causing them to charge you a lower percentage on the money you borrow. In this video, we are going to build a personalized 3-step action plan that you can use right now to optimize your credit profile. By manipulating a few specific metrics, you directly reduce the amount of interest you pay to the bank, keeping thousands of dollars in your own pocket over the life of a loan. Before we begin, pause this video, log into your banking applications, or retrieve your latest physical credit card statements. You need 3 specific pieces of data to proceed: a list of all your current credit cards, the exact balance you owe on each card, and the maximum credit limit of each card. Having these precise numbers ready is the only way to accurately execute Step 2. This transforms the upcoming information from generic advice into a custom financial tool built on your own data. Lenders evaluate your creditworthiness using a specific proprietary algorithm known as the FICO score. This dial indicator shows the FICO scoring range, which spans from 300 to 850. The specific number outputted by this model influences roughly 90% of all lending decisions in the United States. As the dial shifts into a chart, you can see exactly how the algorithm evaluates you. It measures 4 main components: your payment history, your credit utilization, the total length of your credit history, and the different types of credit accounts you currently hold. Understanding the weight of these 4 distinct pillars allows you to stop guessing and start mathematically engineering a better score. Step 1 targets the largest slice of that FICO pie, your payment history. Locate the payment settings in your banking app right now and turn on autopay for at least the minimum balance across every open credit account you hold. Automating this payment process removes human error entirely. You permanently protect the most heavily weighted part of your credit profile from accidental missed deadlines. Step 2 is where we use the data you gathered earlier to calculate a metric called the credit utilization ratio. This ratio is strictly defined as the percentage of your available credit that is currently in use. Look at your statements, add up all your current balances into one sum, then add up all your credit limits into a second sum. This diagram displays how to process those 2 numbers. If you have a $1,000 total balance and you divide it by a $10,000 total limit, you calculate a 10% utilization ratio. Your operational rule moving forward is to aggressively drive this resulting percentage down. Actively shrinking this ratio through targeted balance payments is the fastest mathematical way to positively manipulate lender perceptions and boost your FICO score. Step 3 involves a specific, counterintuitive instruction. Stop using older, paid-off credit cards, but absolutely do not close the accounts. Borrowers consistently fail at this step by falsely assuming that closing a zero-balance account cleans up their financial standing. This split-screen comparison illustrates the exact problem. On the left, when an account is closed, the total available credit pool immediately shrinks. With less total credit available to you, your utilization ratio mathematically spikes, forcing your FICO score to drop. By contrast, look at the right side of the screen. Leaving that old card open keeps your total available credit pool high, allowing your utilization ratio to remain safely low and your score to rise. Preserving these older accounts successfully maintains a healthy mix of credit types and protects your profile from artificial algorithm penalties. You have just completed 3 specific actions: automating minimum payments, calculating your utilization ratio, and isolating your older accounts while keeping them securely open. By executing these specific steps today, your FICO profile is now mathematically optimized for all of your upcoming financial applications. Check your credit score again in exactly 30 days. It takes roughly a month for the reporting agencies to process these updates, which is when you will observe the upward trend. This newly optimized score places you in the best possible position to successfully apply for a spring mortgage or secure a premium credit card. If you are ready to take control of your financial metrics, subscribe to the channel for our next strategy session. A missed bill payment triggers a sequence that extends far beyond a one-time late fee. It signals a failure in reliability that the credit scoring system is designed to penalize immediately. payment history dictates exactly 35% of a FICO credit score. Because this single factor accounts for over 1/3 of the total calculation, lenders use it as the primary indicator of whether a borrower will pay on time. You can neutralize the risk of a missed payment by removing human intervention from the process. By setting up autopay, your lender automatically deducts your payments from a linked account, ensuring the due date is met regardless of your schedule. To build this defense, gather your lender account credentials, your checking account routing and account numbers, and the specific dates your income is deposited. Relying on memory to manage recurring debts creates a single point of failure. Securing your financial leverage requires replacing that manual habit with a verified, automated system. Log into your lender's digital portal to begin configuring the automation. Navigate to the billing or payment settings within the dashboard to locate the central autopay toggle. To power the automated cycle, you must bridge a reliable funding source to this payment portal. Enter your bank account and routing numbers. This designates the exact point where the system will extract funds to cover your balance. Validating this link is the foundational step, allowing the automated protocol to execute accurately every month. Once the link is established, focus on the most critical variable, the timing of the deduction. A common error is setting the deduction for the lender's official due date without accounting for when your own funds are available. If the system attempts to pull funds on a Thursday, but your paycheck does not clear until Friday morning, the resulting overdraft fees can cost more than the original late penalty. Identify the specific dates Capital enters your bank account, such as every other Friday. Intentionally schedule your autopay deduction for a date strictly after your payday. This chronological offset ensures that your funding is always verified and present before the lender initiates the pull. Review your configuration to ensure the dates and account numbers are correct, then select Confirm to activate the system. Maintaining this automated schedule is the direct path toward reaching the higher tiers of the FICO credit matrix. This FICO table shows credit score ratings. Scores from 300 to 579 are poor, 580 to 669 are fair, and 670 to 739 are good. The upper tiers are the target. 740 to 799 is very good, while 800 to 850 is exceptional. Mastering these localized automation protocols provides the data consistency needed to move from the vulnerable lower brackets to the exceptional status. Verify that the system is live by locating the official confirmation signal or digital receipt on your screen. Note that most lenders require a full billing cycle to transition from manual to automated payments. Check your current balances and manually pay any bills due within the next 48 hours to ensure no gaps occurred during this transition. Once this initial buffer period passes, the automated protocol will handle all subsequent cycles without further input. With the 35% segment of your score now shielded, your credit building process transforms from an active monthly stressor into a passive, protected asset. Building wealth is often presented as a waiting game of slow, compounding growth. The credit scoring system contains a structural bias toward borrowers who have simply been alive longer. This generational data shows a steady climb in average FICO scores, from Gen Z at 681 to the silent generation at 760. This trend reflects how the system rewards the simple passage of time, as decades of credit history create a natural advantage. This creates a barrier for younger borrowers who need a 700-plus score now to qualify for a home or a car, rather than waiting 30 years for the clock to do the work. Your FICO score functions as a weighted formula, calculating your creditworthiness based on several distinct financial habits. One of those variables is your length of credit history. For younger borrowers, history is an uncontrollable variable. It cannot be faked, and it cannot be accelerated. Since we can't change the calendar, we have to focus on the factors we can actively influence today. That brings us to the amounts owed category. This category accounts for 30% of your total FICO score, making it one of the most influential factors in the calculation. This metric is driven by a single concept: credit utilization. Mastering your utilization is the only mathematical way to shortcut the system, effectively time-traveling your score to beat the generational gap. Pouring a gallon into a standard glass creates immediate overflow. Pour that same gallon into a large industrial vat, and it barely covers the floor. Credit utilization is the share of your total available credit that you are currently using. To reach a high score, FICO recommends keeping this ratio at 10% or lower. We can see the power of the ratio by looking at two identical spenders. The first spender carries a $1,000 balance on a $2,000 limit. This results in a 50% utilization rate, which actively damages their credit score. The second spender has the same $1,000 balance, but a $10,000 limit, achieving the ideal 10% utilization rate. FICO ignores the raw dollar amount of debt, focusing entirely on its proportion to your total capacity. Improve your score by expanding that capacity. You can acquire significant credit capacity without the downside of constantly opening new accounts. You simply ask your current lender for a credit limit increase on your existing card. Lenders evaluate these requests by looking at your current income and your history of consistent payments. A higher salary at a new job or a long streak of on-time payments are the primary triggers to request a boost. Securing this increase expands the denominator of your utilization ratio. This creates a score boost without requiring you to pay down your balance. Having a high limit only works if you never actually use it. Thousands in new purchasing power can feel like finding free money. The strategy fails the moment a borrower uses that new limit to finance a lifestyle upgrade or larger purchases. Increasing your raw balance destroys the optimized ratio. You end up with deeper real debt while your score drops. The generational catch-up strategy relies on a strict trade-off. You must acquire purchasing power that you forbid yourself from ever touching. Because of the discipline required, a credit limit increase is not a universal recommendation. The decision depends on whether you carry a month-to-month balance. A risk-prone spender accumulating debt must avoid an increase. The danger of deeper debt outweighs score optimization. But for a catch-up builder paying in full, a limit increase efficiently crosses the 700 threshold, acting as a buffer. Your daily habits determine whether a high credit limit acts as a tool for building wealth or a trap that deepens your debt. Ultimately, the scoring system rewards those borrowers who have significant access to credit, but purposefully choose not to use it. A credit limit is not an allowance or a spending target. Ultimately, a high credit limit serves as a passive shield, protecting your FICO score from the mathematical impact of your daily spending. You find an old credit card you haven't used in years. The immediate instinct is to cut it up and cancel the account to simplify your finances. But slicing that plastic actually damages your credit score. Instead of closing the account, our objective is to repurpose it. We are going to turn that dormant piece of plastic into an automated asset that passively protects your financial standing. To execute this setup, you need exactly 3 items: the physical credit card itself, the login credentials for a monthly digital subscription you already pay for, and a primary checking account with sufficient funds. By connecting these 3 elements, you eliminate the manual work of managing old accounts. It creates a closed-loop system that keeps your account active and secure without requiring any daily attention. The reason closing a card hurts your score comes down to a specific mathematical metric: your credit utilization ratio. Vessel capacity is your total available credit. The liquid is your current debt, a healthy 10%. Close an account, and capacity disappears. Your debt hasn't changed, but in a smaller container, it suddenly occupies a much higher percentage of your remaining credit limit. Credit bureaus interpret this high percentage as financial stress. They penalize your credit score, even though you didn't spend a single new dollar. Keeping the old account open serves a strictly mathematical purpose. It preserves the large denominator in your utilization ratio, which keeps your overall financial profile secure. To keep that account open, credit issuers need to see activity. We achieve this by assigning an anchor expense to the card to simulate consistent use. The criteria here are incredibly strict. It must be low cost, a recurring monthly subscription with a perfectly flat rate, like a basic stream service or a cloud storage plan. Do not use a utility bill for this. An electricity or water bill fluctuates from month to month, and those unexpected variable costs can easily trigger an accidental overdraft. Step 1. Open your web browser and log into the account portal for your chosen flat rate subscription. Navigate to the Billing section and entirely replace your existing payment method with the numbers from your dormant credit card. Before logging out, verify that a confirmation banner appears, indicating the new payment method is successfully updated and active. The dormant card is now receiving a tiny, predictable monthly charge. In the eyes of the credit issuer, the account is functionally active, and you haven't introduced any volatile new debt to your budget. Now we must automate the payoff process from your primary checking account to the newly active credit card. Log into the online banking portal for your credit card and navigate through the settings until you locate the AutoPay configuration dashboard. Your digital automation infrastructure is now fully built and operational. The final step happens offline. Remove the physical credit card from your wallet entirely and lock it in a secure filing cabinet. This physical quarantine removes the temptation to use the card. It also eliminates the chance of accidentally swiping it for daily expenses that aren't factored into your AutoPay budget. Your only remaining maintenance task is to set a one-time calendar reminder for next month to log in and verify that the first auto payment successfully clears. Once that first payment clears, the process is complete. You have built an isolated, closed-loop system that guards your credit utilization ratio while demanding zero ongoing mental bandwidth.